Hi, I'm Jim McCann, founder of 1-800-Flowers. I'm not satisfied when I learn something new unless I share it forward. And so we created this podcast to continue that, to share forward the wonderful people we get to meet and most importantly get to learn from and make our lives richer and better. Together we'll cover the human experience. And for me, the human experience is foundational in the idea of relationships. The topics will be far-reaching, but common element you'll see here is it's all about relationships. So I invite you to join us on this journey. Come experience it with us, share your thoughts and ideas, and become part of our community. We'd love to have you. Well, Bob, it's great to spend time with you today because it seems like so many of the things we're talking about and concerned about are things that you know an awful lot about. Maybe let's do a bit of a level set. Full disclosure, Bob and I are friends. I have the good fortune of investing with Bob in a company that he started and runs called Atlas Merchant Capital. And Bob, let's touch on just lightly on the amazing Wall Street career you've had. I think at one point you thought you were probably going to be a teacher for a good part of your life. And and by the way, congratulations on the Huskies.
Thank you.
The men's basketball team won the national championship on Monday night, and you have a degree from the University of Connecticut, so appropriately pride-filled.
Thank you. Thank you. We 3 different coaches and 5 championships since the late 90s. So we're feeling pretty good.
I think it's 5 out of 25.
Yeah, something like that. Yeah.
That's terrific. And this coach seems to be special too.
Special family and a special coach. Yeah, it's been fun to watch. Yeah.
Great
Leadership
story.
Leadership matters, Jim, right?
You think?
Yeah.
Wow, it was amazing to see how they really stepped up in the NCAAs and really dominated and winning by big margins over everybody they faced. They peaked at the right time.
Yep, I think that's right. They hit their stride just coming into that tournament.
Now, talking about your career, Bob, you thought you'd be an educator at one point in your life, and then you, by accident, I think it was, you got into banking and Wall Street. Tell us how that happened.
So I was very happy. My mom and dad were both teachers. I always wanted to be a teacher. I really liked both teaching and coaching and thought that was a great combination.
Your dad was a high school principal?
Eventually, he was started as a math teacher in junior high school and eventually became a guidance counselor, then a vice principal, then a principal of the middle school in Concord, Massachusetts. Eventually became the superintendent of schools. And when he retired, he didn't really want full retirement. He had been superintendent for 7 years, which he felt was right. And he took the job as principal of the high school in Nantucket. Which was transformational for us as a family because it's become a wonderful place for my brothers, my sisters, cousins over the years.
That's great. And Nantucket is pretty much the touchstone for not only your extended family, but for your immediate family.
You know, as our kids were all born and went through high school in London, we first moved there with Morgan Stanley and then spent a few years in Japan, a few years back in the US. And when I joined Barclays in 1996, we spent the next 16 years there. So all 3 of our kids, Jim, as you know, graduated from the American School in London. And the one constant in their lives growing up was Nantucket in the summer. And not only did it give them, roots in America, but it gave them cousins and family. And then most importantly, I could teach them how to become Boston Red Sox fans.
But that's a theme that comes up a lot, Bob, when I get to interact with you and hear about how you talk about your family, is the fact that you're very proud of the fact that they had this wonderful exposure to Asia, exposure to Europe, in particular London, where you lived for 16 years, as you say, and that they went to the American school, but then never lost sight of the fact that they were Americans and by decree, Boston Red Sox fans, because they spent their summers back there. That's a really thoughtful and balanced life experience that your kids were privileged to get.
Yeah, and I think what makes me very happy as a dad is that today, as they look back, our kids feel that that was just a really, really good way to grow up. The exposure by living in London, you're really exposed to Europe in ways that, I mean, America is such a dominant country and such a strong economy that growing up here, I think you don't get the same perspective of the world that you get growing up outside. So it was a wonderful combination to have. Our kids got extremely comfortable with travel and in different cultures and different countries.
I don't know if you'd agree with me, but it seems like being here in the United States, in particular in New York, when you're in financial services, it's both a blessing and a curse that we have this enormous domestic market, because we're never forced to think outside our domestic markets if we don't want to. But if you grow up in London, which is pretty much the financial capital of the world outside of New York, it feels much more international to me. The size of the city, its centerpiece in terms of the Middle East, Eastern Europe, of course, and even Asia seems so much more represented in London. When I'm out in a hotel in London and I'm out for breakfast or a lunch or a dinner, it feels much more international than does New York.
Yep. I think New York is narrowing the gap, Jim. I think New York is more international today than it's ever been in my time visiting and living here. But as you said, starting in the 70s and 80s, London became a very international town. It's almost like a city-state. I think for people who were successful and wealthy, whether it was in India or the Middle East or in Asia or in China, many people aspired for their kids to be able to have access to that education system, both the undergraduate and graduate. But it was very welcoming in terms of foreigners in London. So it had a lifestyle that was very conducive for people from around the world.
Bob, let's look at where we are in the banking system today. We're sitting here in early April with having just seen Credit Suisse forced into a merger at gunpoint, Silicon Valley Bank disappear over a weekend. We saw other banks threatened. We saw First Republic having to get an emergency injection of capital to the tune of $30 billion. Where are we now, Bob? And what do you think the next weeks or months ahead look like for the banking world?
I mean, when I think of where we are today, I think that, we've had two near misses. We've corrected them somewhat, but not completely. And the two near misses I think that we've had were first, allowing inflation to get completely out of control. And for a lot of good reasons, the Fed and the Treasury provided monetary and fiscal stimulus as we had never seen before when COVID first hit, and everyone was stay at home and the economy was slowing down quickly. But they clearly kept the stimulus way too long.
Too long and too much.
Too long and too much. And I think you're absolutely right. It was too much with hindsight, but it's hard to believe, Jimmy. It's April 5th today. It was just a year ago in March of 2022 when the Fed stopped buying treasuries and mortgages. So we've only been in the kind of let's fight inflation for a year. I think the Fed has done a very good job of correcting the mistake, but we're not completely out of the woods yet, as you've seen. We do think inflation has peaked. We do think it's moving down. We don't believe that the Fed or the Treasury believe that inflation has to get all the way down to 2%. I think if it gets to 3 or 3.5, they'll be reasonably pleased. But we're not completely out of the woods yet. And I think that was a real miss by the Fed. I think the second one was SVB. The lessons learned from me on the regulatory side is there was absolutely enough information there to understand the situation that SVB and First Republic were in terms of their asset liability mismatch. A simple stress test of looking at higher interest rates over the period of a year would have identified these issues. And in fact, the San Francisco Fed was somewhat onto these issues, but not acting on them. And I think the shock to the system has now raised the specter of more concentration in financial services in the US, which I think would be really problematic.
Well, let's go back to SVP. You've run money center banks, global money center banks. You ran Barclays for a long time, and you had a saying at Barclays about what your real mission was there. And I think you talked about how your mission there was to balance making banks safer and sounder while also driving economic growth and job creation. And that's a delicate balancing act, especially when you have regulatory forces pressing you to not take any chances, but chances are the things that cause economies to grow and jobs to be created.
100%. And I think what we've seen too much of, particularly in the UK and Europe, is the regulators erring on the side of safe and sound and taking away any ability to be innovative or creative or start new businesses and create jobs and economic growth. And banks have become
or rewards.
Or rewards.
There's no rewards for that behavior, and that's a dangerous thing. I know how you feel about regional banks and the smaller bank community, but when you look at Silicon Valley Bank, it seems like for a layman, it seems like they were victims of their own success. That is, they gathered from the focused community that they paid attention to, the venture capital, private equity-backed business community. They attracted, their deal was, if you want to bank with us, you have to put assets with us because that's what makes the world go round. The more assets we have, the more we can deploy those assets to help your portfolios grow and prosper. But they got too much too quick, and the mistake they made was buying treasuries. So how does that balance? Did they take that? Who could argue with buying treasuries, except that the Fed had signaled that they were going to be raising rates. And that's where you talk about a simple stress test would have detected that issue. But what else could they have done except maybe not take those deposits?
I think they could have taken the deposits and they could have had a much lower duration. But let's be honest with each other and everyone, Jimmy. This was the best advertised series of rate increases in the history of mankind. Yep. So the Fed announced we are going to be raising rates for a while. And for no one on that management team to have raised the red flag, which is, our deposits, as rates go up, our deposits are going into money market funds and treasuries, so they're going down. And all these 10-year treasuries and mortgages we bought are below the market. We have to hedge, or we
held
have
to
to
duration,
sell.
they were fine, but they have to mark to market.
Well, even held to duration, they weren't fine, Jim, because the gap between what they were paying for the deposits was going up. And the return they were getting on the treasuries was staying there. So this was going to happen over, but to your point, it could have happened over 10 years as opposed to one day. But I think the lessons learned here are on the regulatory side. To me, it could have been a very simple stress test. It's hard to believe that they didn't have rate rises as one of the stress issues in the Fed stress test. But I think from a policy point of view, Jim, I think what the Treasury did in this situation was absolutely played a blinder. Protect the depositors. We can't expect our depositors to understand the asset liability mismatch, but the equity's at risk, unsecured creditors at risk, and the management team's at risk. And I think all of those paid the price. Sorry, go ahead.
Except now, what worries me as a layman is, as a country, we have over 30 trillion in debt. And the federal government, without so much as a hearing in Congress, just essentially put the taxpayer on the hook for another 13 trillion in liabilities by de facto saying all deposits are secure.
Well, in theory, I suppose it can go bigger than the banks, but all of that is being paid for by the banks. That's not being paid for by the government. So there is a surtax, for lack of a better word, on all the banks to provide the deposit insurance that funds the FDIC.
But that was set at a $250,000 threshold. Do those rates have to go up now, and will that take more liquidity out of the system?
Well, right now, they've just guaranteed everything for now. And they've said that that will be covered by the banks. And if they have to raise more money from the banks, they will, but it won't be from the taxpayer. Now, you're right. There could be a level. I see no risk of them outrunning that funding. But I think the beauty of this is, number one, You and I have talked about this before. Banks have become more utility-like, closer to the government. We saw it with JP Morgan and others working with the Treasury on the First Republic rescue. We saw it during COVID with Bank of America and other money center banks executing many of the plans for the Treasury. We know that this is a highly regulated business with very, very steep capital, and it's becoming more and more like a utility. To provide a higher level of deposit insurance isn't breaking new ground. To me,
And
what's
Bob,
important.
you've been talking about our money center banks becoming more like utilities for a dozen years now.
Yeah.
And it seems to be, it was true a dozen years ago, and it's truer today. What are the implications of that?
I think the implications they're not fully in place yet, but I think from an investor point of view, they should expect utility-like returns.
Slower capital growth, slower capital appreciation in the stock values, but good, steady cash dividend returns.
Safer and sounder, with less mobility, less agility, less new business.
But
And
that has
so-
a consequence on the economy.
Huge. But in the United States of America, we have a huge, deep, liquid capital market. So my position is address the deposit-taking institutions with some security for depositors. But we have venture funds, hedge funds, money market funds. We have regional banks, specialist banks, community banks. We have 4,500 banks in this country, and most countries have 4 or 5. So this is a huge.
What was that number
advantage.
back 15 years ago before the last financial crisis?
Probably, I don't know, Jimmy, but I would say it would be 50 to 100% higher. There's been consolidation and closing and failures, and it's okay. The day we do not allow companies to fail, the day the economy is not going to grow. We need to allow investors and businesses to take risk, to be mobile, to be agile, and to fail. And I think it's okay to protect the
depositors are protected. Every other constituent at the table, the shareholders, the employees, the leadership, management leadership, they're all at risk. So now we have SVP, Signature, gone. Credit Suisse is a different story. How is Credit Suisse different from what we saw, and why did that go away? I know you're a veteran of the bank. You came in with the first Boston side of things, which is still a viable entity within Credit Suisse. So you've been at Morgan Stanley, Credit Suisse, led Barclays. What happened to Credit Suisse? I mean, the national bank of the country that's 100% about banking and chocolate and jewelry.
And chocolate and jewelry and a few watches. I've often wondered whether the success I had at Barclays, which was a wonderful, wonderful 16 years, and we just grew some incredibly strong businesses in Barclays Capital and Barclays Global Investors. And I often wondered whether, the success I was able to have there was more a function of learning what a great culture was like at Morgan Stanley, or was it a better lesson to learn what a terrible culture is like at Credit Suisse? And I think I had the advantage of seeing both and seeing what a difference they make. And by the way, the other fundamental underpinning of what I saw at Credit Suisse was silo, silo, silo. So they had regional heads, not product heads. They had derivatives go across everything and bringing in the whole bankers trust team in 1992. Every business was a silo. Every business had its own profit pool. And that's why we saw the crises one after another, from Greensill to Archegos. The risk being taken in prime brokerage, for example, with Archegos, wasn't prime brokerage risk. It was outright equity trading risk or equity proprietary risk. I believe that in the end, Credit Suisse was not sustainable because they couldn't earn money. The costs were higher than the revenues, and so the regulators had two choices, which were really three choices. I think if earlier on the management had taken the challenge to restructure Credit Suisse, as you and I had talked about, they had to do a full exit of the investment bank and focus on retail banking. If they had done that earlier, I think they had a chance. But by waiting so long, I don't think the regulators in Switzerland had any option other than to either let Credit Suisse go bankrupt or to force a merger with UBS.
And UBS, I know you're close with Colin, who's the chairman at UBS, and you think the world of him. My question, again, as a layman's watching a weekend or two ago, that crazy situation unfold is, does the Swiss government have the wherewithal to backstop and to make this go through?
I think they'll get through, but is this a risk? It's a huge risk. They have such a concentration now in one financial institution in Switzerland that, to your point, it's as bigger than the government. So I believe they'll get through this, but I would not be surprised if 5 years from today, we aren't hearing the opposite story, which is we need to break up UBS. That will come full circle.
But let's switch to the other side of the coin. Credit
Since we're
Suisse
such young
because
men.
they did it well. We'll be there to see it for sure.
Yes, exactly.
But so UBS, a well-run bank, doing the right things, focused on the right things, an orchestrated, centralized balance sheet, so they know where the risks are. Credit Suisse, the opposite. So it couldn't make money, and it had to eventually go away. And today is eventually. So you think it'll go through? UBS will get their arms around it. They'll jettison the pieces they shouldn't be in, and they'll bring good rigor and good management to the table. And that'll be good for Switzerland. It'll be good for the world, frankly. Again, one more player gone. In the US, back to the consequence of Signature and SVB, is something that you talk about a lot, especially in the business you're in now at Atlas Merchant Capital, of funding, starting, finding assets that need capital, need good management attention to create value. What happens with SVB being the bank now that was doing so much? Who takes up the slack there? Who's lending to these companies? Who's banking these companies in so many different ways? That what kind of a hit is this to the entrepreneurial, startup, venture, and PE community?
So I think that there's more than just SVB today. And to your point, SVB was probably first to really specialize on Silicon Valley and venture capital. I think number one, the venture capital industry is far more mature and sophisticated today than it was when they started. Two, there are other banks that specialize on this. And three, my sense, I don't know this, Jimmy, but my sense is that somebody is going to make a really good acquisition of SVB at a reasonably good price and be able to add that specialism of covering those institutions to its existing business.
So you're not concerned about, is there going to be a valley, a period of time when that particular business community, which has been the engine for job growth and for capital formation and for innovation in the West, particularly in the US, you're not concerned that there's a period of time now that they'll be underserved or underbanked?
Hugely worried. And that's why I think we need a policy response. We need,
okay,
without a policy response, that the US is comfortable with a significantly higher level of deposit insurance, I think it's going to be very hard to see funds like ours or BlackRock or anyone else to be investing in regional and specialist banks until we get some kind of a policy response. I think then there'll be quite good opportunities to invest, whether it's in the capital structure or the business itself and the equity itself.
Go to 1-800-Flowers.com. Find the perfect gift.
And wow the people you love.
Wow. This is amazing. Whether you want to say happy birthday. So cute.
Or I love you.
I love you too. Thinking of you.
Wow.
Go to 1-800-Flowers.com. Celebrate the people you love.
But we need a policy response, Jimmy. And right now, everyone's feeling okay.
We're going to anoint you right now. We're anointing you the fiscal czar of the U.S. in charge of formulating this policy response to ensure that depositors feel comfortable, that the burden for making that comfort come about is properly borne, and that there's a banking system that pays attention, because money center banks are out of that business by their size. And so there's an underserved community. What do you do, Mr. Fiscal Czar?
So I would have a couple of key planks, but I think the two key planks are a significantly higher level of deposit insurance. Let's call it 5 million. And I think the reason for that, Jim, is it's not just individuals who need that protection. I look at my daughter's business. She has
Yes.
to have payrolls on Monday. She has to have inventory, being shipped over from Italy. So it's the small businesses that need their deposits in one place so they can make payroll on a Monday.
It's
so
not practical
5
to
million
spread
or
the money
more.
around. Yeah.
No. And two, banks are already a utility, and this is self-funded. This isn't coming from the government. It's coming from all of the banks. And if we
Yes.
don't do that, we're going to end up with 90% of the deposits in JP Morgan. I think the second plank, though, is let's learn our lessons. And I think this is something that my partner, David Seamus, is really feels strongly about and has convinced me, is at the same time, the quid pro quo here should be some form of mark-to-market accounting, whether it's reported, but not through the P&L, but has to be reported that you see things like these available for sale portfolios, what the mark-to-market impact is. So there's a lot more transparency. And I think those two things together, I think it would be an exciting area to be investing in, regional banks and specialist banks. Well, 40% of the loans to businesses come from banks that are not one of the top 25. So you can take those top 25 banks, and they only do 60% of the business loans, and they do so much of the large ones. So much of lending to small businesses is really done from these thousands and thousands of community and regional and specialist banks.
I meant to ask you this before when you were talking about the more macro pictures. Inflation disproportionately hurts the smaller businesses, I would think, the ones we're talking about now and how they're banked. And I think Larry Cantor is your partner, and we get quarterly to do our fiscal updates. You, Larry, and myself. I get to ask the two smartest guys I know in the financial world what's going on. And you earlier stated, and I've heard Larry state last time we were together, that he thinks we already have inflation on the run, and that the steps that the Fed has taken are doing their job, but there's a lagging effect from what they do. And I'll throw one other smarty pants into the equation. That's Professor Jeremy Siegel at the University of Pennsylvania Wharton School, who says inflation, you want to know where it comes from? There's one source of inflation: government spending, government spending, government spending. And we saw that ad nauseum. So when you throw inflation into the picture, and your point of view with Larry's, that the Fed is appropriately slowing down. Now they've done their job. Let's catch our breath and see what the impact of this rate increase from essentially 0 to 5+% now. What's your near-term outlook? Are we going to see a soft landing, Bob? Are we going to see a malaise in the market? Because you have these big factors: inflation, the Fed rates, the banking system under a little stress. When there's a little stress, everyone pulls on their horns. I'm sure loans aren't being made at the pace they were. What's your near-term outlook? What happens April, May, June, this quarter of 2023 in terms of the business environment? What's going to happen with inflation? What happens with rates? What happens with business formation? What do you see in the next 90 days?
So I think unlike early 2009, when the economy pretty much fell off a cliff, the recession then was very deep, very dark, very scary, and no one knew whether it was going to recover. And it turned out to be fairly short. But boy, was it sharp and dark and painful. I think this is a correction in all the stimulus that we talked about. I mean, this is a fiscal tightening by just not having more fiscal stimulus. So I think we need to work through this, and it's going to be a challenging economy for the next 12 to 18 months, but not deep and dark. But I think the markets are telling us, and I hate to say I don't agree with the markets, but the markets are telling us that the Fed is done and they're going to start cutting rates. I think there is zero chance, barring an absolute huge accident that we can't foresee right now, that the Fed would reverse course. I do think maybe one more 25, maybe nothing, but I think they're going to stay here and watch it and see how this reacts. I think the economy will have real challenges, particularly if you think of what happened to SVB and translate that into the corporate sector. We're going to see a lot of good companies that made some bad structural decisions in terms of capital and funding and debt. And so I think there'll be good opportunities for distressed investing. But I don't see this at all as a deep and dark correction or recession in the US. I think the underpinnings on the labor side, the underpinnings on the housing side, the much milder reaction in energy prices than we had been anticipating, all these things augur well for the fact that we're going to have a challenging 12 to 18 months, but not a deep recession.
Well, it's encouraging to hear, because you've been amazingly prescient for these past dozen years that I've gotten to interact with you a lot, and it speaks well for Atlas Merchant Capital, because you have several pockets of capital, including your debt fund, which has done really well and made money last year when so many didn't and couldn't. So I think your firm is really well positioned, and I think you're right. Just from the network of contacts that I have, I'm hearing from companies that the rules just changed for a lot of companies. So a lot of companies were bumping along saying, hey, I can grow without a big regard for profitability, because I can continue to raise money, because people are rewarding growth without regard for bottom line to some extent. And now they're all being told, if you're not very proximate to turning cash flow positive, the spigot is shut. And I'm hearing terms like onerous and punitive in terms of the rates that people are being told they're going to have to pay if capital is available to them. So in this in-between period of time here, or this several months here, I think you're right. I think a lot of companies are going to say, whoa, I really can't get the capital now, and I have to radically change my business plan. Some will be able to, but some won't. And for someone who has distress opportunities, as Atlas Merchant Capital does, I think there's going to be some amazing opportunities. And I think, as you hinted there, it may be in the banking sector that you guys know so well.
You know, with everything that we've talked about in financial services, there's going to be more and more good businesses that want to be outside of deposit-taking institutions, which are going to have more regulation, higher capital requirements. For all the reasons we'd agreed on, that's going to be the case for deposit-taking institutions. So many operations, whether it's some of the funds that we've talked about, whether it's some of the M&A platforms, there's a lot of businesses that, 10, 20, 30 years ago operated really, really well within deposit-taking institutions that today it just doesn't make sense to have them. And, you hit one of them right away, which is it's very hard for the larger money center banks to really be able to reach out into the smaller towns and smaller communities for some of these small businesses and serve them at a level that they can afford.
Yep. Well, you seem to hint at another category that I think we should touch on, because you'll have, again, a unique point of view. Shadow banking. We know people who are raising very large pools of capital, leveraging it up modestly, and competing with the money center banks to put long-term debt investments into the marketplace. How do you think that business fares?
I think it's great. I mean, I think one of the great attributes that we have, when we see the recoveries in the US ahead of other economies around the world, whether it was in 2008 or other times, we have the envy of the world, a big, deep, liquid capital market. The vast amount of lending that's done to corporates doesn't sit on the balance sheet of our money center banks the way it does overseas. A lot of the mortgages don't sit. So we don't have that concentration of risk in our financial institutions that the European and UK and Chinese institutions have, who don't have that big, liquid, deep capital market. And part of that is the types of institutions that you're talking about, the direct lenders. So one, they create innovation. Two, they create competition. Three, they create different avenues of capital. I just think it goes overlooked often. Of one of the strongest attributes of the U.S. economy is how deep and liquid the capital and diverse the capital markets are. So I'm all for it. We'll see accidents. We have to make sure that the accidents don't have systemic implications. But Failure is okay. Failure is okay.
Bob, we're used to in this economy for the last dozen years or so, 15 years now, of having a low cost of capital. What's your outlook in terms of what will happen with the cost of capital in the months and years ahead? It seems to me that there's a demographic overlay here, and that is people in our generation, the boomers, who are, some of them are retiring, and that changes their risk tolerance and where they leave their capital. So maybe they move it from less risky growth assets to more stable money market kinds of assets. Does that have a consequence in terms of cost of capital?
For sure. And I think it's a function of, the risk-free rate, if you will, the treasury rate is significantly higher than it was a year ago. But I think the spread to that risk-free rate is what you're getting at, Jimmy. And I was seeing some numbers this morning. I don't have them exact. I'm kind of going from something I read this morning. But if you look at the savings of Americans, a vast increase in holdings of cash and cash-like instruments relative to where we were a year ago and during COVID. So I think you're absolutely right that people are reducing the amount of risk in their savings, moving more to cash and money market funds and treasuries. And that's going to absolutely have an impact on the spread between the level that we have to pay to raise equity versus the risk-free rates. And as you and I have seen, we've already had a 450 basis point increase in the risk-free rate just in the last year.
Well, let's look at that. At the end of the day, Bob, it depends on how long your point of reference is. So if you've only been in the commercial marketplace the last dozen years, your point of view is that rates, maybe a distorted point of view, because bonds in the 4% range, mortgages in the 6 to 7% range, unemployment well below 5%, cost of capital increasing but not onerous yet across the board. Sounds like the good old days.
Well, listen, I know it's a shock for many people to see, overnight funds rates at 4.5%, 4.75%. When I began trading at Morgan Stanley in the early 1980s, overnight rates were at 20%. That's painful. I think this is just more normal. And I do believe that starting with the financial crisis in 2008, we've really had easy money for 12, 14 years now in terms of the level of interest rates and the amount of liquidity through various various episodes of Fed stimulus into the funds market. We're getting pretty used to it. I don't think that was healthy in the long run. I recognize there's a shock to get from 0 to 4.5 and 4.75 through the Fed increases of last year. But I do believe the Fed's doing the right thing, and I do believe that we need to learn to manage and invest in a world with real interest rates and real yield curves.
Bob, when we talk about the cost of capital, in the last couple of decades, the Middle East has emerged as a very, very powerful force on the capital formation, capital availability stage. And throughout your career, you've developed relationships and knowledge of relationships and knowledge of the Middle East and the sovereign wealth funds across Asia and the Middle East and Europe. Tell me, Bob, how do we not understand what's going on there? The capital accumulation there is enormous. It's going to continue for decades more, for sure, it seems. You created a firm that serves that community so well. They think more about family, they think more about relationships, and the fact that you have decades-long relationships has served you well, has served them well, and Atlas has been structured to serve them as a constituent investor community so well. Tell us about doing business in the Middle East. How is it different? And how should we be thinking about the influence of that capital on the global marketplace in the years, maybe decade ahead?
The start, Jim, in terms of my ability to truly understand how to do business there was early on recognizing, and particularly as an American, where we grow up where the private sector is so important to have a separation from the private sector and the government. There's truly a blurring of the distinction between what's government, what's business, and what's family. And that's not a value statement. That's just how they've grown over the years. Some of my closest relationships who at different times have been in a family office, at different times they've been with a sovereign wealth fund, at different times they've been in government positions.
HBJ, for example, you just have a great deal of friendship and respect for the fact that those lines are blurry over there and that they move around. It's nothing wrong with it, just different. And you have to understand that to properly serve and do business there.
Exactly. And I think the second thing that's happened, as you said, seems like a long time ago, we developed the relationship at Barclays when I was building the investment bank there in 05, 06, 07 with the Sovereign Wealth Fund, just when it was beginning in Doha in Qatar. And so much of the wealth was created just from energy. And today, they are so much more professional. They are so much more diversified away from just energy. The wealth came early on, much of it, not all of it, through various forms of energy. But the way they have managed that wealth through the Sovereign Wealth Fund and other entities in so many of these countries has become really, really professional. And you see it today because their ability to attract and retain some of the best talent from around the world who are not, people that grew up in Doha, but are willing to move there and be a part of that is very, very striking. So it's been a real positive development for the world to have such mature professional investors who are willing to provide capital to the rest of the world right now. I think the big change we'll see in the next 10 years is further diversification of the domestic economies.
Well, we see the spending there, for example, in Saudi with the MBS and the government there really taking on mammoth projects, using that wealth to create a different future for their economy, for their people, for their country. It's the amount of capital being deployed is remarkable.
I mean, just in the last 5 years, as you and I have been to various, financial services conferences in Riyadh, it's like every year you go back, there's 3 or 4 new unbelievable hotels or new highways, a new financial center. It's remarkable the investment being made. And a lot of it is to attract foreigners, who have companies and have operations in the Middle East to put their Middle East operations. There's a real competition between Dubai, Abu Dhabi, Doha, Riyadh, in terms of if Atlas Merchant Capital was going to have an office in the Middle East, which of those countries do we choose? And that's a good, healthy competition, by the way. It's creating real opportunity for people like us.
Bob, I don't hide my affection for you, my admiration for you, and that's of course in all things business. But it's especially true in how you live your life from a personal point of view, how you think about family, how you think about your kids and their careers, and now your grandchildren and their careers. Of course, you have a daughter, Nell, that's the black sheep of the family because she's doing this entrepreneurial thing like in a real world with her business and home furnishings. And now you have Rob working in the company. What's that like? And how do you think about, you're always thinking about the development and enrichment of each of your children separately and together. Tell me how you're thinking about what you want to do for your kids in the years ahead. How do you want to prod them? How do you want to push them? And then how do you want to make sure they come together in Nantucket in the summer?
Parental bribery, I've always said, is acceptable. It's the only form of bribery that's acceptable. By encouraging them to come to Nantucket, by making it as nice as we possibly can. That's all absolutely appropriate. Because I think, Jimmy, one of the benefits for us of our kids being born and raised overseas is we're very, very tight as a family. Moving to Japan with a 7-year-old, a 3-year-old, and a 1-year-old, and seeing them grow up there, and it was wonderful. It was a great experience. I don't think there's a recipe for how we support our kids and what we do, but I think the important thing is that each of them have found what they're doing to be very, very motivating. So for my oldest son, Rob, he has always wanted to work with me. And I think having, as you know well, working with your brother for many years, that unconditional love and respect for each other is something that you can't replicate outside of family. The important thing for me was to make sure that there are enough alternatives besides, just us working together.
But you made him go work in the real world first. His working together with him is fairly new. And in fact, you keep a little distance between you, about 3,000 miles.
Yeah, well, having him in the London office is probably, I think it helps with the development that we're not together every day, because I do assume that over time we will be in the same position. And Rob wants to do this and wants to be a part of it. So we love it. It's kind of a gift. I think if you ask Nellie or Charlie, they'd say there's no chance I'm working with you, Dad. One, I don't want to be in financial services, and two, I'm not working with you, Dad. But I think it was wonderful that I was able to introduce Charlie early on to some interesting opportunities with the PGA Tour, with Chelsea. But what was great for me is I could introduce him to those opportunities, and then the people would call and say, "Your son's unbelievable," and that's just the great pride you have, that when you give them a bit of an opportunity or a foot in the door, they really take advantage of it in the sense of putting their best foot forward. And as you and I know, we both enjoy watching Nellie and Teddy build their businesses and their family. And the thing about building your own business, as you know and I know, is it's much harder than we let on to kind of the outside world. And I just love the way Nellie makes it all look so easy. And yet I'm sitting with her on Christmas Eve when she's answering customer emails at midnight on Christmas of, "Where's my package?" So
Yes.
It's a 24/7 job to build your own business, and it's great to watch. I love hanging with my kids, and as I have said to them many times, the fact that there's a big Boston Red Sox game in a World Series, and my kids would rather go to that game with me than anyone else, just makes me so happy, and answers a lot of the questions about have I been doing things correctly.
Bob, in a generation or two ago, for our parents, retirement was something that they looked forward to, and in some respects was necessary, because so often they were doing physical and demanding work from a physical point of view. We're lucky to be born a generation or two or three later, because our life expectancy is longer, and as entrepreneurs, we're able to decide whether we work or we don't. We've both been very fortunate. How do you think about the years ahead? And when you think about retirement among our friends, peers, I'm reminded a good friend of mine and a mutual friend of ours, Bob Lesson, who's a very successful Wall Street guy, just an absolute character, and someone who's gone and I miss every day. But I remember he retired. And 2 years later, he called back and he said, "I'm back." I said, "What do you mean you're back?" He says, "Yeah, I'm working again." I said, "Why?" He certainly didn't need to. He said, "Because I ran out of things to talk to my friends about. They stopped returning my calls. I have to work because it's social." And for us, it is social. So how do you think about the years ahead and the options you have or want to have?
So I think I am retired in the sense that I'm no longer with a large organization. I faced a couple of decisions, Jim, as you did, which is I could fully retire and go to Florida and play golf every day. And I have a couple of good friends that do that and love it. They love every single bit of it. They keep themselves busy in some other ways with some boards and some investing. So it's not a value judgment. I just know me. I would be very restless. And when I stepped down from Barclays, I joined the faculty at Yale, and I was going to teach because I taught when I was 25 and 26.
Yep.
Well, I'll tell you, getting ready for a 90-minute lecture when you're 25 or 26 takes you about 5 hours. Getting ready for a 90-minute lecture in financial services now took me about a minute and a half. So it didn't have that. It didn't have that fear that.
Yep.
And so knowing I didn't want to fully retire, it was really, do I want to kind of work for someone else as kind of a vice chair, mentor, door opener? There's a lot of those opportunities, board, non-board. advisory things, or do I actually want to roll up my sleeves and build a business? And I'm just really, really glad that David and I made the decision to do this, because it means I never have to make a decision to step down. I can be a part of this forever. This business will be here, beyond me. It's really, really fun. As you know, I've also said that if I had any idea at the time we started this business how hard it was, I probably wouldn't have done it. But I think now that we've done it, we're like so happy, because all that base building is in place and the franchise is in place.
Bob Diamond, you're a mighty good man. You're a good father. You're a good husband. You're a good professional business person, and you're a good friend. And I'm very lucky to count you among the good friends I enjoy in my life. And I think we're all lucky to have learned from you today as we do quarterly in our conference calls. But I just thought that it was appropriate to dig a little deeper and to share with our audience your wisdom around things that are very, very important at this point in time. So thanks for sharing that all with us, Bob.
Jimmy, I loved it. And as one of my youngest friends, I just want to say I enjoy our friendship as well. Thanks, buddy.
I look up to my eldest, Bob. Thanks, buddy.
Take care.
We put our heart into everything we do. We are farmers, bakers, florists, and makers who grow and create with a passion. 1-800-Flowers. Share with love.
Well, I hope you enjoyed what you heard, and I know I'll be sharing it forward. I hope you get to as well. Let's keep the conversation going. Follow me along on Twitter at Jim1800Flowers and on LinkedIn at Jim McCann. Hope to talk to you soon.